Yeah, so welcome today. We're just here to discuss, a lot of what we see in the market. I'm Phil Verheyen. I'm the mortgage broker here and managing director of Professional Lending Solutions. Our brokerage has been going for 12 years now. Prior to that, I was a business banker at NAB and ANZ for 10 years. So a long history in working in that business banking space and dealing with self-employed applicants around commercial finance, their own personal finance and asset finance and cash flow, all that sort of transactions is what we've been dealing with. Dean's been with us now.
Just over 6 years, I think.
Yep.
Been in the commercial lending game since 2008 after university.
Yeah.
Worked with a couple of majors before joining the team here. So in that, commercial lending, cash flow lending space. And really enjoy working with self-employed customers, business owners to, support their immediate and longer term objectives.
Yeah, awesome. The plan here today is just to give a bit of an idea about, what we're seeing in the market, what we do on a day-to-day basis to try and ensure people get the best outcome for their finance needs, the best outcome to buy a business, grow their business, whether it be cash flow, purchase businesses, whether it's buying commercial premises, all those sorts of things we help people with from a day-to-day basis.
From a market perspective, there's probably two key components that are going on at the moment. One's the interest rate environment.
Yeah.
See trending upwards in that trajectory. What that looks like over the longer term, not quite sure, but I guess it's really important that people are prepared for what a higher interest rate looks like and what they need to do to be able to make sure that they can be in a position to continue their business and if they have any working capital requirements. The other one would be businesses exposed to transport and logistics industry. Obviously, fuel prices are having an impact on a lot of businesses. And again, the tenure of that impact is unknown. Some businesses are in a very fortunate position where they can pass that cost on.
Yeah.
Others, it has a more material impact. So again, it's just about understanding what that looks like and what your business needs to be able to get through that period.
And I think that whole idea of that sort of forward planning, starting to look ahead, am I going to have a cash flow issue in 3 to 6 months? I might have some good cash reserves now, but in 3 to 6 months, I might be struggling a bit. Sometimes it can be harder to get the funding when you're in that position than if you get ahead of the curve and go, listen, we think we're going to need some funding in the future. Let's get on the front foot with that. While we've still got our very strong, historical financials, how can we set ourselves up for the future to ensure that, we will be able to get through any of these lumps and bumps? Because, with the rising interest rates and the fuel issues, we don't know exactly what that's going to look like, but those who have that strong cash flow will be the ones that come out the end and actually have opportunities come up, with, possible, competitors who didn't get on the front foot, who don't sometimes survive these situations.
Yeah, it's a really good point. I think, and that sort of leads into another area that I wanted to touch on was there's still good opportunities in this current market for business owners to take advantage of.
Yeah.
While some businesses are impacted, not all businesses are. It's definitely an opportunity for some operators to scale up and take advantage of opportunities. With respect to the structure of finance, that's absolutely important. And what you said is 100% right. Just because you don't need the money now, you may need it in the future. And aligning your debt structure to the assets that you're acquiring is really important. And similar to the working capital facility, like you may not need a working capital facility now, but if you've got a working capital gap that needs to be addressed, sometimes it's better to get that support immediately rather than when you need it and you have fewer options.
So what are you seeing out there at the moment, Dean? When we're talking to the banks, as we do pretty much on a daily basis, what's their appetite looking like?
Yeah, look, I think the banks are always going to have a strong appetite for good businesses.
Yeah.
But I think the level of detail that they're looking to understand at the moment in the current market is probably stronger than what it has been previously.
Yeah.
So it's really important that there's a strong understanding of numbers.
Yeah.
And that comes from having a really good customers having a really good idea of what their numbers look like and their forecasts, and also having a really good relationship with their accountant, making sure everything's up to date and the numbers and the data that we're getting is accurate and real. And that way we can, again, make sure that we're presenting the strongest possible case to the banks.
I think it's the big thing, we've talked about a number of times, with a bank, you only get that one chance to make that first impression. And if you've walked into the bank and you've presented, some, let's say some loose numbers and, you don't have your ducks in a row, you could very well end up with a no purely from the way you presented it.
Yep.
Which is obviously when we do it, what do we focus on? Having accurate data.
Yep.
We, sometimes it seems like we push back, hard to our clients, but it's because we're trying to get everything ready. So we've got it perfect to give to the bank because we know when we gift wrapped it to them that we're more likely to get that yes.
Absolutely. That's right. We make sure that we're presenting a transaction that is strong.
Yeah.
It stacks up and that's supported by real evidence. So going to a lender unprepared is probably one of the biggest things that we see from business owners. And that's where engaging, finance broker to have an early discussion about what you need to do, rather than perhaps entering into something without an understanding of what the finance market looks like at the moment, can lead to a poor outcome initially.
And not that data isn't always amazing, right? Sometimes there is a negative issue that we need the cash flow for, but it's about actually sitting down and saying, what is the business case to get the extra funding? How would this extra funding support the business to get back to where they want to be and grow their business?
Yeah. That's an excellent point. So financiers want to understand how sustainable is debt provided to a client. Traditionally, the easiest way to do that is looking at historical financials, but that's not the be-all and end-all. There are many other ways that can be presented, and that can be forward contracts, or historically you might have been impacted by something that is no longer an impact on the business. It's about being able to build the narrative that supports what is projected, because historical numbers are important, but they're still historical. It's what's coming that is the most important part, and how we can best articulate that, present to it.
Realistically, it happens a lot. People lose large clients, people's business change, the market changes, and it's, how this funding arrangement is going to help them to pivot, and get back on their feet and then drive it forward.
Yeah, absolutely. Challenges happen every day in businesses. And being able to get through something can actually build resilience and demonstrate to lenders that whilst you've been impacted, you've been able to navigate your way through it. And this is what the second phase or third phase of that looks like. And then, building that narrative to support the business case.
Should we cover off what sort of cash flow facilities are out there, whether it be overdrafts? Sometimes it needs to be term debt. Sometimes it could be debtor finance, trade finance, and what that looks like. And then making sure assets are funded under an asset finance facility rather than using their cash flow. And these capital purchases are funded over a term.
Aligning the debt facility with the suitable product.
Let's go into that. So I suppose a big thing for us, looking forward when people are struggling with their cash flow or trying to forward plan their cash flow, is making sure they've got the right debt structure and facility to suit the need of the actual business and their cash flow. What are the sort of, facilities, we use for that, Dean?
So there's pretty broad range. Obviously, one of the more immediate ones is an overdraft facility. So needing some short-term cash, probably only for a short period to get through maybe a payment you've been waiting on, or you've got an immediate opportunity to get something.
Or sometimes if they're seasonal businesses too, like, those ones that have the big Christmases that need to buy all their stock beforehand, or they traditionally, some are actually slow at that time because it's a wet season and things like that. So that's when they go down in deep into their cash flow. So, it can be different for every business why they need an overdraft and when that's appropriate.
and also identifying that is the most appropriate solution, because sometimes people do come to us seeking an overdraft facility, but the true borrowing cause is they acquired an asset 6 months ago with cash, and that's been the trigger for what has created a shortfall in cash flow.
Yeah, it's like a capital purchase that probably should have been done as like
equipment loan, or if they've done an expansion in their business, which isn't necessarily tied to an asset, but they've opened up a new office and moved into a new territory.
Yeah.
That's probably something that needs to be aligned to a term debt facility as well, because it is a capital utilization, so to speak.
What about for those sort of trading businesses? Is there any sort of more suitable things, those buying and selling and, importers and all that sort of stuff?
Yeah, absolutely. So if businesses that are bringing in stock from overseas, we can utilize a trade facility. So that's a facility where the lender will fund the acquisition of the stock whilst it's on its way to Australia.
Yeah.
And then you have usually that facility goes for 180 days. So you typically have a period once it arrives to be able to sell it, pay back the facility. So it's a short-term funding arrangement, but it is a facility that's in place, so it is able to be repeated.
Yeah.
Another one is receivables finance. So businesses that have payment terms of 60 or 90 days, but obviously wages to pay immediately. That's another option we can explore for customers.
Yeah.
To just try and smooth out that cash flow gap.
So obviously a lot of clients come to us and they're looking to either expand their business or buy their first business. Sometimes, a lot of those times, it's someone who's been working in the industry, wants to buy something in that industry, but often can be people coming new to the industry as well, and just got their eyes on a business they want to buy. What do we sort of, have to sit down and focus on when we think from the bank's perspective of what they want to see in those sort of transactions?
So the most important part in those transactions is how well that individual is prepared to be able to take over and operate that business successfully.
Yeah.
So if they are acquiring a business in an industry that they have been operating in, that's a really important component.
Yeah.
Or if they're buying a business that they're already operating in and it's in addition to their operations, and obviously that works well as well.
Yeah.
We want to make sure that we and the customer understands the numbers.
Yeah.
So that's probably a component, not only just the numbers of the business, but what that will look like again in a future state when either the business is added to the existing operations or a new person takes over.
Yeah.
If there's any operational changes that happen within that.
Yeah.
And a component of that is what assets are utilised to achieve that outcome for the business. So whether that's equipment, what stock levels are required, is there any key contracts that may be in jeopardy under new management? That's something that definitely needs to be understood.
What are the sort of things we often look at a bit differently when we look at the funding? People come to us and I think they're buying a business, and the value of the business is just the value of the business, and they don't kind of fully understand what goes into making that up, and whether that's stock or goodwill or assets and all that sort of stuff.
Yeah. So when we're looking at financing business acquisitions, we typically break it down into sort of three components. First one is the goodwill, what stock is being utilised, and that's usually part of the purchase price. And the other one's the equipment that's included within the business. And how those three components are funded usually vary within the one transaction. So typically for equipment that's been acquired as part of the business, we can do 100% of that, usually over a 5-year term. The equipment needs to be of value and identifiable.
Yeah.
But that's a way that we can dilute the goodwill component and then structure the goodwill component over a suitable term again, and that's going to be aligned to if there's a lease in place, what that may look like. If there's any key contracts that have a material tenure. Again, every business is different, and the key components are going to change slightly. But typically, and then a stock is usually done over a working capital facility, whether that's a trade facility or an overdraft.
Yeah, and the things you obviously have to look at sometimes if they're retail stores, how long's on the lease and those sorts of things. We've got to align the finance terms to those sorts of things. So, that matches up.
The biggest common error that we find is people being unprepared. And a valid question to that is, well, how do people know how to be prepared? And the best place to start is having a conversation with us.
Yeah.
We can provide some insights and guidance to what being prepared looks like. And, a key component is going to be knowing your numbers, making sure that you've got all of that information readily available.
Yeah.
Because once you present a case to a bank, if you do go straight to a bank, they are going to be making a decision on the information that's presented. So that can lead to a less than ideal outcome in the first instance.
Well, it's a simple thing, right? They don't know what they don't know.
Correct.
We for a living, we put these submissions together. Yeah. So we know, and we work inside those banks. So we know exactly what credit's looking for.
Yeah.
We know what, on a daily basis, which banks have the appetite. There's some clients come to us and say, I went to this bank and, they weren't interested. I never would have walked into that bank because right now they have no appetite for that sort of transaction. So, it's not you, it's them. You unfortunately waste your time just going into the wrong bank. So, we're looking at this on a daily basis to go, right, I've got this sort of transaction. These are the two banks who are really going to either give us some decent pricing or actually do the transaction. Don't waste our time with the rest of them.
And another component of being prepared as well is making sure that you understand the critical timelines that exist within a transaction. Because if, for whatever reason, there's something that needs to be done hastily, that is something that can still be achievable, but might be forced to use another funding line, which perhaps is less ideal in the immediate term, but can still get the transaction done.
Yeah, and sometimes, when we're talking to different banks, right, it's not always about what's the cheapest bank. Sometimes it's the bank who will give us the highest, amount of debt. Sometimes it's who's going to do the deal the quickest, or sometimes some banks come and they lead with this great rate, but we just know they're never going to do the deal. So we just won't waste any of our times trying to talk to them, because all we're going to do is get 2 or 3 weeks down the track and go, why, we're back where we started.
So one of the other really important components when we're talking about larger transaction is covenants or post-funding conditions, which are things that the bank want to see satisfied in a period, and it's usually it's annually, sometimes it's half yearly, sometimes it can be quarterly, and that's dependent on the nature of the transaction and I guess what underpins the expectations moving forward that they've aligned their debt to.
Well, they're the type of transactions the bank's got a large exposure to, right? So if something was to go wrong, the chance of them getting their money back is fairly limited. So they're just trying to keep a bit of a closer eye on them, just to make sure anything comes up.
Covenants conditions are definitely not a bad word. They're a great thing because they do enable exposures to be allocated to businesses that are unsecured. But the banks just want to make sure that they are across what's happening within the business, and if there's any early warning signs that may need to be addressed. And again, it's probably the bank understanding what's happening and what the customer's doing to address that moving forward, more than anything else.
Of course. So often we get a number of clients come in and their financials aren't ideal. They're working with a great accountant that's minimising their tax, but then something comes up and they want to either grow their business or acquire property personally or for the business. What options do we have around that type of transaction, Dean?
Yeah, so we've got quite a broad range of options in that space. We do have a panel of alt doc lenders that will consider home lending and commercial lending, utilising alternate sources of income, whether that be a couple of BAS statements, an accountant's letter, bank statements, that type of thing.
Yeah, often that's called low doc.
Yeah.
Yeah.
And then we do have another tier that's probably slightly beyond that. A really broad panel of private lenders that will do low doc or no doc. But that's very much what we would call a security lend, where it's aligned to the asset specifically. Typically, the LVRs or loan to value ratios are a bit lower for those types of transactions.
We've still got some of those other lenders as well that will just actually go in and use some data now. They go into the accounts and sort of see the turnover through the accounts, and based on that, they can make a decision whether they could happy to provide some unsecured funding for that business. Just based on what's actually going through the account. Just looking at that turnover, they've got their own matrices they look at and go, well, this business should be able to support this level of debt or overdraft.
Yeah, that's a really good point. And sort of touching on that as well, we do have some lenders that are able to do 100% finance for commercial property purchases.
Yeah.
The way that that's structured is there is a sort of a shorter term unsecured component and then a traditional property loan. But that is a really good way for business owners that are looking to get their own place because they may have the rent is being reviewed and about to go up, that they can leverage the rent that they've paid historically to support an acquisition.
We see a bit more these days. There's a lot of people considering it, wanting to buy their own, factory or warehouse, and they may not have their own personal equity, so they're looking at doing things through, self-managed super. And we're not financial planners; we don't really give advice. And or financial planner, they come to us. What sort of stuff do we look for when we're trying to do those sorts of transactions?
Yeah, so borrowing through a self-managed super fund is a really good way to get into the market, particularly if you've got, obviously, strong super balances.
Yeah.
Typically, that lending is assessed off the rental income that the property is going to receive.
Yep.
And that superannuation.
Yep.
It can be taken to another level where we do look at the broader profitability, but as a first instance, it can be a simplified way of getting into the property market. Simplified's a terrible term. It's not a simple way.
Yeah.
It's not complicated, but it's cumbersome. There's lots of moving.
I think the big thing there, with that self-managed super fund, it's new to, it's foreign to a lot of people. Often every one of the transactions comes in, the contract's in the wrong name, and it's just sort of getting on the front foot with people and saying, hey, listen, this is what it needs to look like. These are the moving parts we need. Have you spoken to your accountant? Have they set it up? And just knowing in that space, you could be doing lots of different things in that self-managed super fund. Residential, you could be buying an investment property, but if it's commercial, you could be buying for that as an investment or own occupied. So if you're renting your own, property at the moment, you might be able to buy your own in your self-managed super fund and pay yourself, as a landlord, to buy that property, which is a great outcome for a lot of people.
Yeah, absolutely. Particularly in a market where rents are going up and need to find another way to, I guess, create value for themselves.
Yeah.
I was going to we don't really have an actual example, but we could give an example where, talking about that structuring, we had somebody that came to us with a working capital requirement, had recently purchased some vehicles in cash rather than going through a traditional overdraft facility. We're able to back in that with an equipment loan and align their debt to.
Yeah. A loan, didn't have enough equity, didn't quite understand the structure of that, of what they were buying and the different avenues. And unfortunately, they've walked in, probably didn't get the most experienced banker helping with it. I think we could say the client's, experience was limited and potentially they didn't have the same level of experience in the banker without saying it was this bank. So we got some examples, we've dealt with recently. We had a client come in, they'd gone direct to a bank. Again, as we discussed earlier, not sure they went to the right bank. And, being, for want of a better term, naive on the way to present it to the bank, they went in there, seeking, the whole amount of funding, to buy the business and, ended up getting a no. But, how were we able to turn that around, Dean?
Yeah, so I guess touch on people don't know what they don't know. So they went in with a sort of an open mind around how to present it, but it didn't pan out. Potentially, not dealing with the most experienced banker at the time as well. But essentially, we're able to pull that back, understand the different funding components of the business that we touched on earlier, to be able to break down what is something that a portion that can be done through equipment finance.
Yeah.
What is a good goodwill component, and how much of that can be funded? To achieve, making sure that serviceability is fine, and operating leverage is within metrics, and that that it all makes sense and stacks up from obviously what it looks like historically, but then obviously what they're expecting into the future as well.
Yeah. Yeah. No, far better outcome. In the end, we actually had a number of banks who were keen on the transaction as we presented it,
Yep.
which made all the difference, which resulted in, ultimately the client being able to buy that business and, getting a great structure, being able to compare two banks and, being open with the banks that, they were competing for the business, made them both get quite aggressive with their terms and their pricing, which ultimately is always going to be the best outcome for the client.
And how much of the current inflation is due to that, I don't know. I feel like it was a bit of a problem well before that, and the most recent data, the conflict was in its infancy. So what that looks like from a transaction and customer's perspective, I guess realistically the most important thing is making sure that your debt is as efficient as effective as it could possibly be. Making sure you've got the appropriate facilities in place to be able to support you, and that you've got the best loan available. But
whether
there's
that
never
be like
been a
term, rate, all that sort of stuff.
Yeah, absolutely. There's never been probably a more important time to making sure that what you have is the best that is available.
Because potentially coming into the next few months, we're talking the highest interest rates we've had since 2011. It's and realistically, debts would be over double where they were at that time. So that impact on individuals and businesses is going to be double what it was back then, if not not far off triple for some. Let's be honest. Over the last 15 years, it's been a considerable increase in people's debts levels. So it's going to have that huge impact, especially when you consider what the cost of living's like outside of that at the same time.
Yeah, absolutely.
If you're seeing these rates, increase and you're worried, how's this going to affect me personally? How's this going to affect my business? What's going to be coming up in the future that we need to think about and get on the front foot? Make sure we've got that cash flow in place. Make sure our facilities are the best they possibly can be. That's when they need to really sing out, sit down, come in, have a chat with us both and work out, what is the best way forward for you and your business and your family.
Absolutely. That forward lens is really, really important. So whilst you may be in a sound position now, it's again, just making sure that you've got the best possible solution, and that if you may have a need in the future, that we're planning for it in advance so that we can move quickly or even have something there ready to go when you need it. Yeah.
Or get on that front foot, again, don't want to sound like vultures, but realistically, there's going to be opportunities coming up, with your competitors. There are some people who will struggle through these high interest rates. People who have much higher levels of debt may struggle through some of this. So there could be some opportunities out there, to grow your business, and to acquire, property and or other businesses.
Absolutely. And as we've touched on as well, banks are willing and keen to support really good transactions. They might want a bit more info than they have previously, but they will get behind it. So there is opportunities in the market too. Again,
because one thing we see, and this goes across the whole business, and when we talk about people buying businesses, we've seen a lot of really good business people turn around some businesses that they're buying that are performing poorly, but knowing what they do in their business and knowing what they can then do to the business they're acquiring, can turn that around. And obviously the risk on the other side, when we're concerned about people buying businesses without the experience, is we've also seen, people buy businesses, that were successful that have gone the other way. So it's why it's really important to go, hey, listen, does this transaction make sense for you and the business you're buying?
Probably a really important component of that is when most people think vehicles, but it's much more broader than that. It's essentially any gear that's utilised for business that is of a value and is identifiable. That is something that can be funded. So making sure that again you're aligning your debt structure to the assets of your business.
Yeah.
Really important component.
Absolutely. And I think the big thing we can do there is not only decide, what's the best option out there, is, working with you and your accountant to make sure we get all this stuff, make sure it's all aligned, we're all on the same page, and really whatever we decide, it's best for your whole group and the best outcome. So it's not just about the best rate. We've got to get that structure right and make sure that what we're doing, is ultimately going to be for the best interest of the. So realistically now, if you've got those questions, you don't know where to go from here, sing out, give us a call, no obligation, come in and sit down with Dean and I. We can book it over the phone, on Teams, whatever. Let's jump in and, see what we can do to help you and grow your business going forward.